Fios is not cable. We're wired differently, which means you can get the fastest internet available with equal upload and download speeds from 50 to 500 megs. So you can upload 200 photos before your favorite song is finished. Click the ad and switch to Fios today to get our best offer ever.
This is a download from BFM 89.9, the business station.
Good morning, Dodge. The US dollar moved lower against Japanese yen and euro last week. Do you think investors are second-guessing December job numbers and growth numbers?
Yes, Abraham, good morning. I do believe there's a second guess. The first reaction to the numbers was quite positive, and then when started to look behind it and to see where the jobs growth was, it was not in the 24 to 50 age group area, which is really what we need. So, yeah, I do believe there's second guessing, and I think we're going to have another round of fluctuation and volatility before we get some kind of solidification in the perceived growth of the U.S. versus the rest of the world and the perceived reaction to the increase of our interest rates relative to what other world banks are doing.
Wage growth is seen as important drivers to push up inflation. Do you think any delay in further Fed liftoff is going to impact this growth?
Well, Abraham, that's a good question. I'm not sure how to answer it. I think on one hand, the fact that the Fed does increase will give an indication of confidence in the growth. A lack of it will be misinterpreted as being directly related to the perception of whether wages are going to grow or not. So, yes, I think that what the Fed does will have an overweight in the implication to the U.S. dollar and to the perception of what's happening with our wage growth and economic growth, and also the number of jobs that are being created.
Tying this with what happened in China, the market meltdown in China last week punished major markets as well. What can we make out of this?
Well, first of all, when the China market does not do well and goes negative or falls, it's not just the perception that the Chinese economy is doing worse than expected, which I believe is true. It's also the fact that the Chinese government, which has had a significant impact on trying to control what is supposed to be a rather free market, is not able to do so in the way that it wants to. And so I think that is an additional perception that's affecting other markets. And what we're seeing now, if the Hang Seng or other Chinese indices open, hold, go up, and then go to new lows, that is negative for the rest of the world, and particularly U.S., and we open so much later, and we are seeing that, and the perception is being driven by sentiment that's being created by what's happening in China. So right now, what is happening in China is having a much more negative influence on other world markets, not only in terms of the actual performance, but also in terms of sentiment.
Because of this, what does it mean when we know there's a high level of correlation between U.S. stocks and Chinese companies? Do you think there needs to be more reconciliation and help, or for that matter, from the more developed markets in China?
Not sure. I'm not sure what the answer is now, and I'm not sure that the Chinese market knows what the answer is either. I think it's going to take time to work this out. I think that in the meantime, there's going to be a lot of volatility. It's going to be driven by the Chinese market and how the market performs relative to what kind of support the Chinese government gives it.
With this very sizable sell-off, are we going to see any purchase or buy signal being triggered?
Yes, but not yet. What we're looking for is a submission of sentiment to the downside. What we like to see, and what has been helpful in the past, is an overwhelming percent of the volume of both up and down stocks being on the downside. It's called a 90% downside day. Once we have a 90% downside day, then the next thing to look for is a 90% upside, a reverse reaction where the sentiment is enough that investors feel that there's been enough of a move to the downside to start to come back in. We've seen some terrible percentages to the downside in terms of downside volume, but not that 90% critical factor. And yes, it's a very technical indication, and unfortunately we're in that type of market where volatility is rampant, and we need to have some kind of conviction We're not seeing that yet. But yes, once we have that, then there will be a bounce that will be more substantive than the day or 2-day bounces we are going to be seeing over the next 2 to 3 weeks.
Because of this volatility, do you expect some government bond yields to drive up to actually negate this kind of sentiment?
It would be very difficult not to have that happen. So if it does, it would not be unexpected. I suspect that some of the money that's been going out of the equity side will be looking for yield to protect itself for the short term until the market finds some support, and then there can be some incentives to go back on the equity side. So I suspect as that happens, then the yields will start to flatten out again.
Let's focus on the domestic U.S. market. It's earnings season, and the financial sector is set to take a slump from poor market activity. Citibank is set to be the biggest contributor in this sector. Any ideas where this growth is coming from?
Well, Citibank is unusual, and that's probably why it's going to be one of the most watched stocks in the financial sector. And the financial sector is earning a structurally higher share. Well, Citibank itself is earning a structurally higher share of its revenue and profit from the international markets, more than its peers. And in particular, Abraham, about 40 to 45% comes from emerging markets. So this will be a very good indication as to what the prospects are. The pace of shareholder capital for Citibank returns, the dividend, the increase in dividend. Citibank has trailed its peers. It was the last major bank to raise its dividend payout, and it's among the lowest. So that is going to be what we're watching for is what Citibank will be doing with regard to its dividend. Revenue for 2050 probably will have dropped around 2%. It's among the banks that may be helped by the short-term rate increases. So we're going to watch to see how it handles the potential increase in interest rates over here. It has a better, if there is a better global growth outlook and capital markets boost, that kind of positivity will affect Citibank more than its peers. And so I think we'll be watching as well as others, but Citibank will be one of the critical banks to watch to see how it got through last year and how it's going to be affected by the interest rate increases and also abroad.
Will we expect some major move from their largest competitors to actually narrow this gap?
I suspect there will be an effort, particularly by Goldman Sachs, for example. I do expect that. It's not something that's going to happen overnight, particularly since the financial sector has pulled back in investment banking and in trading in particular. So I think it's going to take time to resurrect some of the other areas of growth for domestic banks over here. But Citibank has not pulled back as far as the others relative to its percent dependent upon the international markets. And so I suspect that Citibank will continue to lead. And also the perception or the question is going to be, is that the area of growth for 2016? If it is, Citibank will do fine, particularly in a rising interest rate environment.
Finally, we move on to oil. Oil is right now miserably close to the $30 mark. What's going on here?
What is going on is a supply and demand, and there's just so much supply. And you look at the new round of conflict between Iran and Saudi Arabia, if this continues, it will make it even less likely that the group will ever manage to agree on production ceiling when it next meets this summer. And also Saudi Arabia is unlikely to cut its output to help Iran regain market share. So we expect to have supply in the market for quite some time, which will make it very hard for prices to go up. If you take a look at crude, unfortunately the target's 31.42 and then 29.67, 28.84. Those are technical levels based on the trading of the commodity as a commodity, not in terms of the fundamentals of the commodity. But unfortunately, the implication is quite negative for the price of oil over the next 3 to 6 months. And at some point, there will be a support found. It won't go down, but we have not found that level of support yet. And I suspect it will be below 30, and then once it gets back above 30, then I think it becomes much more supportable, and then I think you'll see a return to more traditional levels. It'll take quite some time, but I suspect around the second and third quarter of this year, you'll start to see a support of the price of oil above 30, and then it'll start to increase.
Right, thanks, Dorge. That was DorgeDorland, Chief Investment Officer of Landor&FuestCapitalManagers in New York.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.
This year, I will chew 117 number 2 pencils.
I will doodle 9 Staples notebooks to death.
When it comes to school supplies, it's guaranteed your kids will go through a lot.
I'll make a whole lot of paper airplanes.
I will lose my backpack.
That's why you get guaranteed savings for back to school at Staples.
I'll give away my last pen to Nathan in math class.
Get guaranteed savings at Staples, and right now, 1 subject notebooks for just a penny with a $5 purchase. Staples, that was easy. Valid on select SKUs while supplies last. Limit 6.